Hi learners, Professor Joe here. Today's video is a continuation of the previous video about how to trade options. So let us see the first part of how to trade options. Today we will be discussing about long call options. As I told you guys that today is a continuation of the previous video that we had discussed about options. So if you have not seen my previous video, this is a good excuse. You can go and check the previous video on options. So in the previous video, I've given an example of a buyer buying a house. So the terms used while buying, how it can be interchanged in the options world. Let us have a look at it. The 1 lakh rupee that was the down payment that was expected by the builder, in the options world, it will be called as premium, the cost to enter the trade. The 1 crore price that the builder was quoting after 6 months is called as the strike price in the options world. If the price of the house goes above 1 crore, then the owner is said to be in the money when you talk about the options world. And if the price of the house is below 1 crore, then the owner is said to be OTM, that is out of money. 1 crore, 1 lakh is the break-even price for the holder of the option, and 6 months in this case was the expiry period. So if you try to combine the real-world example with the options that we are going to discuss, or the long call option that we are going to discuss today, this is how you can bring it together. In this case, in the real-world case, the builder, the one who is making the building or constructing the building, is the writer of the option because the builder is selling. Whereas you or the purchaser of that contract is the holder or the buyer of the option. Now, this is a diagrammatic representation. So basically, there are 2 lines in this. One is the vertical line that is called the profit and loss line. I mean, the curve goes up, your profit is going up, and as the curve comes down, you are in a loss. The middle line, which is called the zero line and the price line. Okay, so in the profit and loss vertical line, once the curve is above the zero line, then the option is said to be in a profit. And if it is below the zero line, then the option is said to be in a loss. Basically, the option that you are entering into. Okay, and the price moves horizontally from left to right, the price goes higher. So in the left, the price will be lower, and the right, the price will be higher. Okay, this is something that you should always remember when you're looking at a diagrammatic representation of an option. Now, in this case, you can see that 1 lakh is the maximum loss because this is a long call option. So in a long call option, the only loss the person can bear, the maximum loss a person can bear is the premium amount. Okay, so in this case, it is 1 lakh rupee. The break-even point is 1.1 crore. So as the price keeps going up from 1 crore and above, once the price reaches 1.101 crore, 1.01 crore, you are said to be at break-even. And once the price of the house goes above 1.01 crore, the buyer of the option will be in profit. Okay, so as you can see in the diagram, there is a strike price, which is 1 crore. There is a break-even point, which is 1.1 crore. And there is a higher price, which is 1.25 crores and 1.35 crores. The price is going up. And you are above the zero line, that means you are in profit. And how much ever the price goes below, whether it's 0.85 crores or 0.65 crores, the loss maximum is limited to 1 lakh. So this is the advantage of being in a long call option. There are some more terms we will see. That is ITM, that is in the money. When an option trader is in a profit, he is said to be in ITM, that is in the money. And when the option trader is in a loss, it is called as OTM. Okay, so we will see what these terms mean. And the strike price is basically ATM, at the money. Okay, so these three terms are very, very important because you need to understand at which level you want to enter the market and what will be your profit at that particular level. All right. So I hope you have understood the diagrammatic representation of an option. We will look, this diagram is something that is going to come over and over again when it comes to options. Okay, so you need to understand. So the basic, again, I will just explain this diagram. The vertical line is the P&L line, that is the profit and loss line. So the middle line where the price line is drawn is called as a 0 point. Okay, so this point over here is called the 0 point. If the curve, this is called the curve. So if the curve is above the 0 line, it is said that the option trader is in a profit. And if the curve is below the 0 line, then the option trader is in a loss. And the horizontal line is the price line, where there will be a strike price, there will be a price below the strike price, there will be a price above the strike price. Now we have taken a long call option in this example because it is the easiest to understand. As we go ahead, there are other three options which we need to understand. Basics of option, that is long put, short call, and short put. So these are three other options that we will be explaining in the coming videos. Now we are going to look at long call option. And when we are talking about long call option, we are talking from the buyer's point of view of a long call option. That means you want to enter the market and you want to take a trade in long call option. Now remember, when you are entering a trade in the stock markets for a long call option, your objective is not to buy the underlying asset. Your objective is to make money in the premium. That means in a long call option, say example, you enter at 100 rupees premium. Your goal is to exit the trade or square off the trade when your premium is 110, 112, 115, or maybe 200 also. Okay, if you made a good profit. Okay, your goal is to exit in a long call option when you are making profit in the premium. Now, there are some conditions that you need to understand. We will look into those conditions. Now, as I said, the first condition is in long call options, when you are entering the market, your goal is to make profit in the premium. So if you enter at 100, if you make 110, exit. Second goal is when you are in a long call option, never wait till the expiry period. So if you're in a weekly option, try to exit couple of days before the week ends or the expiry date ends. If you're in a monthly option, then try to come out of the option at least a week before the option. So the longer the option is, it is better for you because whatever you are predicting about the markets, the chances are that it can happen. Shorter the option period, the chances that whatever you have predicted might not happen within that period. Then you might lose out on the option. So it is always better to enter into a monthly option. But yes, if you're sure about the market, you can surely enter the weekly options too. The other terms used in the option market is terms like strike price, that is the price at which you enter the market. Premium, that is the cost that you have to pay to enter into an options trade. Now, when you want to enter into a long call option, you can enter at three different prices. Yes, you have three options to enter. ATM is at the money. Okay, that means the strike price is almost close to where you are entering the market. The next is ITM, in the money. The current market price is above the strike price. Okay, that is when it is called ITM. We will look at an option chain that will give you a better understanding of it. Okay. The third price that you can enter is at OTM, that is out of money, where the current market price is below the strike price. Now, whenever I'm saying current market price, the current market price of the underlying asset. Okay. So you need to understand that whenever we are talking in option, we are talking about the current market price. So there is a current market price of the underlying asset. So we have understood terms like long call option, we have understood premium, we have understood ATM, ITM, OTM, expiry date. Now let us try and put all these things together. And remember, we are putting it all together for somebody who want to trade in long call option. Now, when you want to trade, first thing is you have to look at the underlying asset. Now, in this case, we will take Nifty as the underlying asset. You can see that the Nifty price is going up. So your prediction for the market is that the price might continue in an upward direction. Understand that only when the price is going up, you will choose long call option. Now, looking at the chart, you are clear that the price is going up. Your view is bullish. So now, as I said, you have three options. You can enter at a strike price, which is ATM, or a strike price, which is OTM, or a strike price, which is ITM. But to understand, we have to look at an option chain. Okay. And remember, whenever you are trading options, your goal is to make profit in the premium. Forget everything else. When you are trading for a retail trader, when a trader is trading options, your goal is to make profit from the premium. Okay, so you need to understand that very, very well. Forget all the other logic. The most important thing is premium. You have to make money in the premium. Now, this is called an option chain. Now, in an option chain, to the left side, you will see calls, and to the right side, you will see puts. Okay. And somewhere in the middle, you will see that is ATM. Now, if you remember the chart, so we'll just go and have a look at the chart one more time. So as you can see in the chart, the price, current market price is 19,564. So ATM over here, as you can see, is 19,550, which is very, very close to the underlying current market price. So ATM is always close to the current market price. Now, there are multiple information that is given in an option chain, like OI, change in OI, volume. In this video, we are not going to look at those details. In this video, we are going to understand the basic, how you are going to enter a long call option and how you are going to profit out of it. So you saw the chart, your view is bullish, you see the option chain. Now in option chain, you are getting a chain of prices. That's why it's called an option chain. Okay. So from lower to higher as you go below. On the left, it is calls. On the right, it is puts. So if you want, you can take a price of 19,550, which is ATM. And if you see the last traded price for the ATM, it is 109. Now you have an option to enter at this price. Okay, the strike price will be 19,550 and the premium that you're going to pay is 109.85. Or you have an option to enter a price which is below. That means where the market has already crossed that level. ITM, in the money. That means the market has already crossed that level. Okay, so you can enter in an ITM probably at 19,200 strike price or 19,300 strike price, or you have an option of entering where the market has not yet reached at say 19,800, because currently the market is around 19,550, right? So you have multiple options in this chain of prices. That is why this is called as an option chain, where it is giving you multiple prices options and it is giving you different premium prices where you want to enter. Now let us see what some more information is given in an option chain other than ATM, ITM and OTM. Option chain is very easily available. You just have to Google it, you will get it. Because options can be traded in equity, currency, interest rate, commodities, all these options are available. Next, there is weekly, monthly expiry dates. So those things are available. Okay, so there are multiple options available. So options is a wide range of financial instruments are available for you to trade. That's why it's a very liquid market, and Traders love to trade in the options market because they do not have to wait for liquidity. Your entry and exit is very, very fast in the options market. Okay, so this is the information that is available in the option chain. Now let us look at different scenarios. Say example, if you have entered in an ATM, if you have entered in an ITM, and if you have entered in an OTM, how the premium works out and when you will make profit. Example, we have entered at 19,550 and the price has moved to 19,770. So we'll take three examples. Example number one, you entered at 19,550 where the premium was 110 rupees. It was 109, so we will take it 109.86. So we will take a round figure over. Okay, so 110 rupees. Assuming that the market moves, the underlying asset price moves to 19,700, this premium will also increase and it will become 220 rupees. So you entered at 110. The current premium after the price goes up is 220. So you have made a profit of 110 rupees. You can immediately exit the market with a profit of 110. The second, you entered in ITM. That means the market has already crossed this level, but you decided you want to be more safer. So you entered at 19,300 strike price, which is below the current market price, because the current market price is somewhere close to 19,550. So you entered at 19,300. Here the premium is high. It is 310 rupees. Assuming that the market moves to 19,770, the premium would approximately at that time become 470 because you paid 310. The premium would go up from there because the market moved in the direction you assumed the market would move. So your premium became 470. So you made a profit. You entered at 470. So assuming that the market went from 19,550 to 19,770, you will make a profit. But you entered with a premium of 310 and the current premium is 470. So you made a profit of 160, which is a higher profit. Why? Because you entered in ITM in a price which was much, much below the strike price. So you made a higher profit. Now, the third option is you enter at a price where the market has not yet reached. OTM, out of money. The current market price is 19,550 and you decided to enter at 19,800. Since the price has not reached that level, the premium will be very less. In this case, the premium is 15 rupees. So you paid 15 rupees, but we are assuming that the market went only up to 19,770. You entered at 19,800 strike price with a very low premium, but the market did not go. So in this case, the premium would be 7 rupees. So you entered at 15 rupees, but you exited at 7 rupees, so you make a loss of 8 rupees. So this is how when you enter at different levels, it will affect your premium. At the same time, it will affect your profit. But remember, your goal as a retail trader is to earn money out of the premium. There is second important thing that you have to understand when you're in a long call option is the premium loses its value as the expiry date reaches closer. So this is very important thing that you must understand. When you are entering into a long call option, your assumption should happen quickly. If it takes time, you are losing out on the premium decay. Let us see what it is. This is how the premium decays as it reaches close to the expiry date. The second important thing, as a long call option or a buyer of an option, you should remember is you should never wait till the expiry date. Because if you wait till the expiry date, even if your assumption is right, the market moves upward, but it reaches the expiry date, you might lose out on the premium, although your assumption was right. So it is very, very important that when you are taking a long call option, do not wait till the expiry date. Exit as soon as your target premium is achieved. That is when you will make profit. Do not wait till the expiry date. For example, this is how the price of Nifty looks like. It is around 19,550. If this orange vertical line is your expiry date, and if you assume that the price is going to move a little bit down and then straight go up, then a long call option is a perfect option that you are entering into. But if you think that the price might go sideways for some time before it reaches your target, then entering a long call option can be dangerous. There can be decay in the premium, and although the price might go up, but you will still lose out on the premium and you will get a loss in your long call option. So very important to remember that if you think the price will go quickly up, then only enter into a long call option. The benefit of entering into a long call option is the margin required is very less and your loss is limited only to the premium that you are paying. That is very, very important and plus point about a long call option. Once again, if you look at the summary of this video, we discussed long call option. It is for traders or retail traders, especially who believe that the market is going to be bullish and the price is swiftly going to go up. Do not wait till the expiry date in a long call option. Exit as soon as you make your profit in the premium or as soon as your target is achieved. The goal in a long call option is to make profit from the premium and not by buying the underlying asset. And remember, premium decay, so do not stay too long in a long call option. The goal should be to quickly come out of the trade. So that is all put together about long call option. So I hope you have understood what a long call option is from this video. If you don't understand it in one go, please go through it over and over again, because for some people, it can become confusing. Now, if you enjoyed this video, and if you understood or learned something out of this video, please like and share. And for more such videos in finance, technical, fundamental analysis, personality development, please subscribe to my channel. All I can say is keep learning, keep growing. Thank you. Namaskar.